In addition to the potential long-term risks that higher deficits and debt present for growth, are there also risks to the functionality of the Treasury market? When shocks hit the market, and if so, how might the Fed respond?
Well, the functioning of the Treasury market is incredibly important, and it does function very well. It's the most liquid and most important, probably, financial market in the world, certainly one of the most important. And we did see some, at the beginning of the pandemic, you may remember that the Treasury market lost function because normally in an emergency, money flies into the Treasury market, but the pandemic was such an unusual event. People didn't want to own longer-term securities. They only wanted to own effectively cash, and so we had to jump in and support that. I think more broadly than that, it's just important that the Treasury market remain well regulated, and that companies have an incentive to do intermediation in the Treasury market. It's relatively low risk. It's very important for the economy, and it's important that that be the case.
In the March 2020 episode that you're referring to, the Fed ultimately had to step in as a lender of last resort. Would the Fed do that if there were similar disruptions in the initial issuance of treasuries? That was in the secondary market, as I recall.
We're not a fiscal actor, so that was a situation where we have a mandate that we share with other agencies to look after the financial stability, and part of that is if really important markets break down, and they kind of all broke down at the beginning of the pandemic. They just stopped working, and so we set up a series of facilities to backstop those markets, but they actually didn't get used because just the fact that we had the facilities restored credibility, and the markets started working on their own. It was remarkable. So in the case of a financial stability event like that, or the global financial crisis, where really the whole global financial system was at risk given the failure of a number of large financial institutions around the world, in those kinds of things we can use these emergency tools, but they're not for every event. They're really for financial stability events.
You mentioned that it's a little bit too early to know what policy beyond the remit of the Fed would look like. We don't know exactly what the fiscal picture will look like, but we do know directionally that tariffs are likely to go up, right? Even if we don't know how much, we don't know necessarily if it'll be exactly what was described on the campaign. And I'm wondering how you're thinking about that. Well, go on, sorry.
So what matters for us is we don't stand in judgment over these policies in any way. What matters for us is to what extent will new policies have an effect on our mandate goals of maximum employment and price stability, and do we need to change our policy because of these changes in order to achieve those goals? And that's the answer to that question is not obvious. So let's say that there will be some tariffs. We have no idea what that's going to look like. That's one thing. Another thing is, what about retaliation? That changes the picture. In addition, that's happening at a time when there could be fiscal policy, which could be supportive of the economy. So what's really the net effect? We don't take one piece of this. We're looking at the whole economy. In addition, remember, this is way over a $20 trillion economy. Many, many things affect the economy all the time. It's not that common that changes in government policy have immediate effects in the achievement of our goals. That could be the case, and of course we will use our tools as we're supposed to do to foster the achievement of maximum employment and price stability. That's what we do. That's what we always do, and we'll do it here. I'm just saying we're going to be careful to wait and better understand the net effects of these things as those things affect the achievement of our goals.
If you look back to the previous round of trade wars under Trump's first term, the Fed staff prepared a report in the 2018 Teal Book where they basically talked about whether the Fed should be looking through any price increases that result from tariffs and assume that it's a one-time step up in prices as opposed to self-perpetuating inflation or not. And the staff said at the time that the that the Fed should look through the tariff increases so long as, one, you think it's going to be a one-time adjustment and not a series of adjustments, and two, so long as inflation expectations are anchored. It's not obvious that either of those conditions will hold the next time around, right? Back in 2018, we had decades of very low inflation. Now we've had a much more recent experience with higher inflation. And as you point out, there could be a series of retaliations and tariffs and counter-tariffs and counter-tariffs. So are the risks bigger this time that a price shock could feed into trend inflation?
They're different. We're in a different situation. The debt situation has changed substantially. And you're right, we're not, 6 years ago and such, the inflation was really low and inflation expectations were low. Now we've come way back down, but we're not back where we were. It's a different situation. Inflation's still running above 2%. But we'll take all of that into account. I tell you, though, the answer isn't obvious until we see the actual policies, and even then it's not obvious. So I just think we reserve judgment until we actually know what we're talking about. And I don't want to speculate. I don't want to guess. I think it's more important that we wait and see what actually happens.
Last time around, as you suggested, there were mixed consequences. There were mixed effects. And as I recall, during these previous trade wars, the Fed actually cut rates several times because there were consequences for growth and investment and confidence. So how does the Fed respond if higher tariffs result in both higher prices and slower growth? Do you have the tools to respond to that?
Well, so you're absolutely right. So in 2000 and I guess it was 19, we cut rates 3 times, and that was right after there had been fiscal stimulus, there had been tariffs, and it really was because the net effect of what was happening, and of what was happening around the world too. There was global growth was really soft. There was a feeling that the U.S. economy was softening, and we actually cut rates 3 times, I guess beginning mid-year, and that kind of worked. That restored confidence. We felt at the end of 2019, we felt like that had really worked, and that situation was quite a good one. Of course, then the pandemic arrived, and none of it mattered. So that's the way it happened. But that's exactly my point, though. We had a meeting the prior December, and it briefed us on what might happen. But what actually happened was something quite different. So and I'm not talking about the pandemic. I just mean the way that played out. I don't think we started that year thinking that it would be appropriate to cut rates 3 times. So just know that we will do what we believe is the right thing. That's what we're always going to do. But I think it's really important to reserve judgment and see how this plays out. We're still months away from a new administration, let alone knowing the real details of what's going to happen and then being able to project what will be the net effects on the economy.